Okay, good afternoon, good evening. My name is Jin Hong Zhang. Welcome to our weekly Love Your Tax seminar. And today we will focus on depreciation, and that is in the context of real estate investment, equipment leasing, as well as renewable energy investment. Uh, so we are fortunate to have our expert, cost segregation expert, Joshua Jacobs here. So after I do a little bit of introduction, we'll have Josh to dive deeper on the topic of cost segregation. So before that, I just want to quickly review the context. In our previous seminars, we talk about the contact, the importance of contact. So here I want to, in this context, I want to talk about the types of income. You have the earned income, capital gain, and the passive income, right? And so today, when we talk about some flow-through losses from real estate, we again needed to look at the passive income and the impact of capital gain and how we have a strategy long-term as we take advantage of the depreciations. And then, the strategies. So today's strategy is really just deduction, right? And there's some shifting, different entity from the pass-through entity to yourself. So that's the strategy. And then in terms of vehicles, we're focusing on real estate and business and tax saving altogether. Okay, so review that, three types of income. You have the earned income, where you need to not only pay income tax, but also self-employment tax or payroll tax. And then you have the capital gain, where you pay, the capital gain, the increase from the base. And then the passive income, where you didn't participate, and then you have that income, right? So always remember, passive loss can offset passive income only. So when in the real estate strategy, we want to create a loss through depreciation in today's context. So we also want to create, if it's a passive loss, then we need to create passive income to offset it, to use that passive loss. If you have a high active income, then we will think about how we can transform the passive loss into active loss, such as making your spouse real estate profession, like that. Or if you are in an LLC, make yourself as an active managing member of the LLC by participating in Zoom calls, like that, right? So the pass-through entity, it's really, you do not pay tax in that entity. So all the loss or income will pass it through to yourself. Okay, that's the pass-through entity. And an example of this is you use an LLC. Let's say you put assets into the LLC. Now, this LLC, if you say 99% of the owner is your donor advised fund, then you get the deduction. It passed through. So even it's an LLC, it's still as if it's yours, right? So as long as it's a pass through, then it will pass it through you. The benefit will pass through you. So same way today, when we talk about depreciation, you want to put your assets in an LLC, and then the depreciation will cause a loss, and then you generate a K1, it pass through to you personally, and then you can take advantage of the loss. So you can have all kind of a partnership or corporation, LLC. I prefer the LLC because it has flexible choices. You can choose to use it as a partnership in the context of real estate. You can also have an LLC like as a real estate management company, and you can elect a C Corp, right? S Corp. Then you can pay yourself a reasonable salary, or you can have some like a C Corp for something else. Let's say you have a marketing consulting company to provide a service for your S corp, then it's a C corp. You can use it to shift income. So that's the LLC. I like it. It's flexible. Okay, and then the structure really, as we talked, these partnership LLCs really goes here, right? So whatever comes, the loss comes from here, reduce your income. Okay, and then in the context of the Inflation Reduction Act, you got a 30% credit, investment credit for residential energy credit and commercial energy credit. It's both 30%. So this makes this depreciation, right, even better. You're adding fuels on the fire already. So the idea here is, and then also I want to talk about leverage. So the idea here is this. So if you have, and let me go back to this place to demonstrate. So, we have strategies upon strategies. So let's say you invest in real estate. If you invest in real estate, you put $200,000, okay, 20% leverage. So $200,000, you leverage it, no, 80% leverage. So you bought $1 million house. Now your depreciation base is $1 million. So your bonus depreciation, cost of segregation may give you even more than your down payment as depreciation, right? So the cash putting out, you can here cause a loss of probably $200,000, as if the cash you're putting out is all deductible. So that's a very good deal, right? So that's the beauty of the leverage plus depreciation. Okay, you go hand in hand, then it's a turbocharge your deduction. Now, even better with the Inflation Reduction Action, if you invest in a renewable energy project, in addition to the depreciation deduction with the leverage, you can also get a tax credit here, can offset your tax. So again, the tax credit is 30% of the total project. So if you put $200,000 there and you leverage 80%, so that's $1 million project. So you got a $300,000 tax credit here, right? So that is a really good deal, okay? So, and then we can be innovative. We can do equipment leasing, for example. You don't even need to buy equipment, right? There's a company, there's an LLC, you can join them as a partner. And they can, now you can receive a K1 and get all the benefit we talked about, the depreciation plus the leverage. And if it's, something qualified by the Inflation Reduction Act for renewable energy tax credit, then you qualify for that as well. So this is the residential tax credit 30%, and the commercial as well. You can have that. So that's a real good opportunity. It's available throughout 2023, and there's no annual limit. So you can every year you can use it. So the way you do it is, for example, the equipment leasing situation. You, as an investor, invest in the project, and the project usually is the developer. They have an LLC, so you get the deduction as the owner. You get the K1, you get the depreciation deduction. Okay, and then sometimes the developers they develop it first, and then they sell to tax equities. So this is called tax equity investor. It gives you good tax credit. And then, of course, when you depreciate your real estate, when you sell it, you need to basically count the depreciation, as something you've already taken advantage of it, right? So it will need to reduce the basis, so your capital gain is higher. So the way to reduce capital gain is use 1031 exchange. You just keep exchanging, and defer all the capital gain there, and then you never needed to pay capital gain. Okay, that's the game to play. And then when you pass away, there's something called a step-up basis. So your children, even if they sell the property, they don't have to pay any tax because the basis is stepped up to the market value on the date that you passed away. And of course, if you put into opportunity zone fund, after 10 years, you never need to pay any capital gain tax. And if it's a rental property, if your income is below $100,000, you can just do it in your Schedule E, and you get a $25,000 loss with the depreciation and interest. However, if your income goes high, it phase out. The way you do it is to do an LLC, and as this is a rental property business, then it will escape this this rule, basically this restriction. Okay, so the way we do it, we work with you as the kind of general contractor, right? And then we partner with a specialist to work with you. Today we have a specialist, Josh, to talk about the cost of segregation. So Josh, are you ready? You can share screen.
Yes, sir. Okay. Do you mind pulling up that that slideshow I sent over to you? I don't.
Oh, the PDF file? Okay.
Yeah.
Okay.
Okay. But yeah, so I work for Cost Segregation Services. We are the top firm in the nation for cost segregation. The company's been in business for over 20 years and done over 45,000 studies. All of the studies that we complete are engineering-based studies. So the goal of a cost segregation study is to identify parts of commercial or rental properties that are eligible for accelerated depreciation. So this works on all types of rental properties, the short-term, long-term rental properties, any type of commercial property you can think of. It just can't be land or primary residence. So what we do is we go out to the property and we put an exact dollar value to every component of the property, and it's divided up usually into 3 different categories. So there's 5-year property category, which is mostly interior items that are non-structural. So think carpet, lighting, cabinets, stuff like that. 15-year property, which is land improvement. So think parking lot, pavers, fencing, signage, stuff like that. And then either 27.5 or 39-year property, which is structural property. So we put a dollar value to every component of the property, and then anything we identify as 5 or 15-year property, that is the part of the building that you're able to accelerate the depreciation on. Instead of waiting 27.5 years or 39 years to depreciate the property fully, the straight line method, by doing a cost segregation study, we identify parts of the property you're able to accelerate. So usually it's about 25% of the building that you're able to accelerate, and then depending when the property was purchased and when it went into service determines on how much of the 5 and 15-year property you're able to take in the first year. As it all stands right now, anything purchased and went into service from about middle of 2017 to 2022, you'd be able to take 100% of all the 5 and 15-year property. Proper 2023 property, you would take 80% of all the 5 and 15-year property in the first year. A 2024 property, it's 60%, so it's being phased out 20% every year. But there is the House did pass a bill that would actually extend 100% bonus depreciation through 2025. The Senate is, we're hopeful that the Senate will pass that bill here shortly in the next couple of weeks, but we're waiting to find out. We still have a lot of clients doing studies for tax year 2023. Nothing would need to change about our study, even if that law does get passed. Instead of taking 80% of all the 5 and 15-year property, you would just take 100%. So nothing about our study needs to change. Like I said, we go out to the property. It does help to maximize the study's benefit to go out to the property just to try to capture all that 5 and 15-year property. And our studies take about 3 to 4 weeks to complete. And once the study's done, we provide you and your CPA a copy of the final engineering study. These cost segregation studies can be done on even properties that are that been already on a tax return from a prior tax year. Amended return isn't needed. We actually can fill out, it's called a Form 3115, change in accounting method. So what that says is that you were doing straight line depreciation. Now you want to switch to accelerated. Next time you file your taxes, you insert the cost segregation study and that 3115 form. And then that's what you would need to apply the cost segregation study to a property, purchased or, went into service in 2022 or before. So this cost segregation, this normally, well, it kind of, depends on the client. Sometimes these losses are passive or active. Passive income can offset passive losses can offset passive income. And there are some things that our clients do. The short-term rental loophole is a way if you material participate in a short-term rental that's 7 days or less. A lot of times you can use that. You can change that passive loss into an active loss and offset W-2 income. Also, if you or a spouse qualifies as a real estate professional, then these losses can be active as well. So we do studies all the time. Even if it's passive, at the worst case, it would offset the income produced at the property, and can actually offset income at other properties as well. But if somebody does qualify for a real estate professional, or it's a short-term loophole scenario, then it makes sense almost every time. And there's also some of our clients are owner occupied, so they own the building and they run their business out of the building, which can be a really good tax benefit, because if you choose the grouping election in the first year that the building was put into service, you can actually use that depreciation to offset the income produced by the business. So a lot of our clients, end up buying the building that they're operating out of to take advantage of that grouping election. And then you talked about the stepped up basis. That's a long-term goal somebody has. That's a great way to avoid taxes, and also the 1031 can help defer taxes, so you don't have the appreciation recapture that you normally might have if you sold a property that you did take a decent amount of the appreciation on. So that's kind of I think that touched on most of the points I wanted to touch on, but more than happy to answer any questions that there might be. I guess um, also be good to note that the studies start around $2,000 and they go up from there. And it's the fee is mostly based on the size of the property. So if it's a small rental property, single family home, it'd probably be around $2,000, and yeah, it goes up from there.
That's awesome. Thank you, Joshua. So give us a rough idea. If I have $1 million, say just a rental property, right? You know, and if I placed in service, say 2021, how much depreciation can I take this year for 2023?
Yeah, so for
segregation.
a 2001 property would not be eligible for bonus depreciation, because bonus depreciation is for properties purchased and went into service after 2017. That being said, you could still do a cost segregation study, because you would be able to take all the, it's been, 2021, 24, so 23 years. You'd be able to take all the 5-year and all the 15 year property that hasn't been taken. Most of our clients have, bought a property in the past, 6 years or so. So if, say, somebody bought a $1 million property in 2020, you always have to back out at land value, because land is non-depreciable. So if we took 20% out for land, that leaves us with $800,000 building value. And then if we were able to, 25% of the building value is pretty common. So 25% of that 800,000 would be 200,000 would be the estimate for the bonus depreciation in the first year. And we can always run a free estimate for any clients. It only takes a couple of days. We'll give that estimate based on looking at the property online, when it was purchased, and then we'll also have our set fee in there as well.
Awesome. Thank you, Josh. So are you saying that bonus depreciation only applies to property that placed in service before 2017?
So it needs to be purchased and gone into service. It's, I think, September 2017 and after. You can still use cost segregation for properties before that, because we've been in business for 20 years, even before bonus depreciation, came out in 2017. But if it's a property after September 2017, you're able to, really accelerate the depreciation and take that 100% bonus.
So then if it's the property I purchased in 2021, then it still qualifies as a...
Okay, 2021. I thought you said 2001 at the start. I'm sorry. Correct.
Yeah, okay.
20.
Good.
Yes, sir. Yes, sir.
Yeah. I think there's some phase out, right? After a certain year, right? Instead of 100%, or I think instead of 80%, it becomes
2024 is 60%. So this year it's 60%.
Okay.
Next year,
80%.
Yes, but like I was saying, there's that bill that would actually be retroactive, and it would change 2023 back to 100%. That's the tax relief for American families.
Okay, so how does that 100% or 80% mean? So I already got the cost of segregation, right? So I was thinking cost of segregation will allow me to deduct, 100% of the cost of segregation depreciation this year, right? So what is the bonus depreciation? Is there something more than that?
So what cost segregation will break, in the different categories, the 5 and 15 and 27 year. So if we identify that the 5 and 15 year property adds up to $200,000, if it's a property that was put into service in 2021, you would take that full 200,000 in the first year. For a 2023 property, it's still that 200,000 as the 5 and 15 year property, but you take 80% of that in the first year, which would be 160,000. The remaining amount, you still take the remaining amount over 5 years and 15 years, but
Okay.
you would just take, 80% of that 5 and 15 in the first year.
Oh, okay. So basically you have a percentage of the depreciation and the cost segregation that you can be allowed to take.
Yes, and that's why our study doesn't change, because we just identify the 5 and 15 year, and depending on what year and what the law is, that dictates how much you can take of the study. But the study stays the same, even if in 4 years is 0% bonus depreciation, we'll still be in business because people still want to take the 5 year over 5 years.
Yeah.
And the 15 over in 15 instead of having to wait 27 years for the entire property.
Yes. So the new bill will allow the 100% bonus depreciation until 2025. Correct?
Yes, correct.
Okay. So basically extend 2 more years. Because
Correct.
2023 is 100%, 2024 is 80%. So
no, so 2023 is 80%. 2024 is 60%. So if this bill gets passed, it would be retroactive to 2023. So a lot of our real estate clients who have done a study for 2023 are waiting to file because they want to see if the law gets passed or not. If it gets passed, when they send them the return, they're going to claim 100%. If it doesn't, then they're going to claim 80% for 2023. So, a lot of our clients are kind of waiting to see if the Senate passes that same bill that the House passed.
okay, good. Thank you.
Yeah.
Any other questions? Anybody?
Something I'd add in that, depending on the type of the property, will depend on how much the benefit of the study. If it's just, it's just a warehouse with no office and it's a completely bare bones, a shell building, then there's just less non-structural components. And then there's less 5 and 15 year property. We still do cost segregations for, for those types of, properties. But if somebody has a townhome that's, super renovated, high end appliances, really nice, flooring and everything, then the benefit of the study is even more, just because there's just more that 5 year property that's eligible for bonus appreciation.
Sure. Thank you, Jacob.
Yeah.